Hello students, my name is Vaishali. I'm a faculty in School of Finance and Commerce, Galgotias University. I welcome you all to this presentation. The name of the topic is Standard Costing. So let's get started with the presentation. The topics covered are: we would be discussing the prerequisites for the success of standard costing, that is establishment of cost center, classification of accounts, types of standards, and setting standard cost in detail, then revision of standards and difference between standard costing and budgeting. So for establishing a system of standard costing, there are some prerequisites which are required. These are establishment of cost center, classification of accounts, types of standards, and setting standard cost. So let's further look at these prerequisites in detail. First is establishment of cost center. So let's look at the meaning of cost center. A cost center is a location, a person, or an item of equipment in respect of which cost may be ascertained and related to cost units. So cost centers are set up for cost ascertainment and cost control. A center which relates to people is referred to as personal cost center, whereas a center which relates to location or equipment is referred to as impersonal cost center. Now, while establishing these cost centers, the management should look who is responsible for which cost center. In many cases, each department will form a natural cost center, but there may be a number of cost centers in each department also. Now, for example, there may be 6 machines in a manufacturing department and each machine may be classified as a cost center. So, cost centers are essential for establishing standards and analyzing the variances. Second prerequisite is classification of accounts. Now, accounts are classified to meet a required purpose. Classification may be by function, revenue item, or assets and liabilities item. Codes and symbols are used to facilitate speedy collection and analysis of accounts. Next prerequisite is types of standards. So the standard is the level of attainment that is accepted by the management. These standards are generally classified into 4 main types. They are ideal standard. So the ideal standard is the one which is set up under ideal conditions. Now these ideal conditions may be maximum output and sales, or best possible price available for materials, most satisfactory rates for labor and overhead cost. As these conditions do not continue to remain ideal, so this standard is actually of very little practical value. It does provide a target or incentive for employees, but is usually unattainable in practice. Second comes expected standard. So this is the standard which is actually expected to be achieved. The standards are set on expected performance after allowing for a reasonable allowance for unavoidable losses. So standards are normally set on short-term basis and require frequent revision. Now expected standard is actually more realistic than the ideal standard. Then third is the normal standard. This represents an average figure based on the average performance of past years after taking into account all the fluctuations which are caused by seasonal or cyclical changes. Generally, normal standards are attainable and provides a challenge to the staff. Then comes basic standard. Now, this is the level which is fixed in relation to a base year. So, the principle that is used in setting basic standard is very similar to what we use in statistics while calculating an index number. So this basic standard is established for a longer period and is usually not adjusted to present conditions. So just like an index number against which subsequent price changes are measured, so basic standard enables to measure the changes in cost. It only serves as a tool for cost control purpose because this standard is not revised for a long period, but it cannot be used as a yardstick for measuring efficiency. Then final prerequisite is setting the standard cost. So the success of a standard costing system depends upon the reliability and accuracy of the standards. So therefore, every case should be taken into account while establishing these standards. The number of people involved with the setting of standards will depend upon the size and nature of the business. The responsibility of setting standards should be given to some specific people. Generally, in a big company, a standard costing committee is formed. So this committee generally comprises of the production manager, personnel manager, production engineer, sales manager, cost accountant and some other functional heads. So the cost accountant is a very important person here. He has to supply all the necessary cost figures and coordinate the activities of budget committee. He must ensure that the standards which are set are accurate and present the statements of standard cost in most satisfactory manner. Now standard costs are set for each element of cost, that is direct material, direct labor, direct expenses and overheads. The standards should be set in such a manner so that they can be used as a tool for cost control. Now let's briefly look at how the standards for these elements of cost are set. So starting with standard cost for direct materials. If material is used for manufacturing a product, it is known as direct material. This direct material cost will include two things: quantity of material and price of material. So first thing, while setting the standard for quantity of material, the quality and size of the material should be determined. The standard quantity of material required for producing a product is decided by technical experts in the production department. Now while fixing standard for material quantity, a proper allowance has to be given for normal loss of material. This normal loss will be determined after carefully analyzing various factors. Now second component, that is setting price for material. Setting standard price for material is very difficult because the prices are regulated by external factors than company management. So before fixing standard, factors like price of material, price quoted by suppliers, price of materials already contracted, provision for discounts and many other such things are considered. Next is setting standard for direct labor. The labor involved in manufacturing of a product is known as direct labor and the wages paid to such labor is known as direct wages. So the time required for producing a product should be ascertained and labor should be properly graded. Setting of the standard cost for direct labor involves two things. One is fixation of standard time and second is fixation of standard rate. Now standard time is fixed by time or motion study or any past records or estimates. While fixing the standard time, normal idle time should be allowed for normal delays, idle time or any other contingencies. Then second thing is labor rate. Now labor rate refers to the wage rate applicable to different categories of workers, and this rate will depend upon various factors like demand for labor, policy of the organization, if there is any influence of unions, method of wage payment and such other factors. Also, if any incentive scheme is in operation, then that anticipated extra payment should also be included in determining the standard rate. The accountant will determine the standard rate with the help of the personnel manager. The whole objective of fixing the standard time and labor rate is to get maximum efficiency while using the labor. Next is setting standards for overheads. Indirect costs are also known as overheads. These costs are those costs which cannot be assigned to any particular cost unit and are incurred for the business as a whole. So the overhead costs are classified into fixed, variable and semi-variable. Standard overhead rate is determined for these on the basis of past records and future trends of prices. Now, standard cost is based on a number of factors. These factors may be internal or external and they vary from time to time depending upon different situations. Now, the standard cost may become unrealistic if it is not revised according to the changed circumstances. Then a question arises as to what should be the period in which standard cost should be set. So if standard cost is set for a shorter period, then it is expensive and frequent revision of standards will impair the utility and purpose of standard cost. Whereas on the other hand, if standard cost is set for a longer period, then it may not be useful, particularly during periods of high inflation and rapidly changing technological environment. So therefore, these standard costs are normally set for a fixed period of 1 year and then revised annually at the beginning of the accounting period. If there are major changes, there can be a revision within the accounting period also. But if the changes are minor, then the causes of difference between actual and standard cost may be explained without revising the standards. Now there are certain conditions which will necessitate the revision of these standards. Some of these conditions could be a change in price levels of material, labor or overheads, change in technology, change in the method of production or production mix, product mix, then change in the plant capacity utilization or in designs or specification or a change in the policy of organization. So these are some of the factors which could lead to revision of standards. Now let's further look at the meaning of budgeting briefly and how budgeting and standard costing are similar and also how both of these techniques differ from each other. Now budgeting is defined as the process of preparing plans for future activities after considering the objectives of the business organization. This will also provide the steps for collection and preparation of data, and then later deviations can be measured. So thus budgets are prepared on the basis of future estimated production and sales so that profit can be found out. Budget is an estimation and quantified plan of future activities to control and coordinate the uses of resources. So let's look at the definition of budget. A budget is a financial or a quantitative statement that is prepared for a period of time for the purpose of attaining a given objective. Budgeting is a process which includes both the functions of budget and budgetary control. So budget is a planning function and budgetary control is a controlling function. The objective of standard costing and budgeting is to achieve maximum efficiency and cost control. So under both the standards, both the systems, actual performance is compared with predetermined standards, and if there are any deviations, then those are analyzed and reported. Now budgeting is essential to determine the standard cost, whereas standard costs are necessary for planning budgets. Both of these are complementary in nature. Other than these similarities, now let's look at the differences between standard costing and budgeting. Now let's look at some of the differences between standard costing and budgeting. So standard costing is based on technical information and it is fixed scientifically, whereas budgeting is based on standard cost, historical cost and estimates. Then standard costs are used mainly for the manufacturing function and sometimes for marketing and administration function. So it does not require functional coordination, as not all the functions of management are using standard costing. Whereas on the other hand, budgets are prepared for different functional departments such as sales, purchase, production, finance, personnel department, and therefore it requires functional coordination. Then standard cost emphasizes the cost levels which should be reduced, whereas budget has emphasis on cost levels which should not be exceeded. In standard costing, variances are usually revealed through accounts, whereas in budgeting, variances are not revealed through accounts and the control is exercised by putting budgeted figures and actual figures side by side. Next, in standard costing, a detailed analysis is needed in case of variances, whereas in budgeting, no further analysis is required if costs are within the budget. Standard costing sets realistic yardsticks and therefore it is more useful for controlling and reducing cost. In budgets, generally maximum limit of expenditure is set without considering the effectiveness of expenditures. Standard cost is revised only when there is a change in the basic assumptions and basis, whereas budgeting is done before the beginning of the accounting period. Next, standard costs are based on the basis of standards set by management, whereas budgets are set on the basis of present level of activity. So now we have come to the end of the discussion, and here on the screen I have written some of the references that you can use to enhance your knowledge on the topic. And I thank you all for listening patiently.